Okay, guys, this is the second lecture in chapter 5. Second lecture in chapter 5, and we stop for learning objective number 4. Just to remind you about the first lecture, we explained the changes in sales volume affect the contribution margin and the net operating income. Mainly, we express the contribution income statement, contribution format income statement. Just to remind you that this format will start with the sales and will take the variable costs only in order to calculate something called the contribution margin. And then we deduct the fixed cost in order to calculate the net operating income. We calculate the break-even point when the net operating income will be 0. So just referring to my example, this company, RBC company, was in a break-even when it sells 400 units. So I need to sell 400 units in order to break even. Again, the break-even means a net operating income of 0. So in order to get a 0 profit, we have to sell 400 units. And this was the issue for the first lecture in chapter 5. We do have the equation form, which refers to profit equals to sales minus variable cost minus fixed cost. And we said that we need to use the contribution margin for 1 unit, which is the price minus variable cost per 1 unit. And we calculate the break-even by the equation model or equation method by assuming that the Q is the missing. So we need to calculate the Q, and we calculate it to be 400 if the profit was 0. The second thing we explain or we discuss the graph for the CVP, cost volume profit graph, and we show that the break-even point will be the conjunction between the total revenue and the total cost. And this point referring to the break-even point was represented by units, 400 units or $200,000. And we calculate the break-even point using the contribution margin model or the formula model. We call it formula model. Before that, we explained the contribution margin ratio, which refers to the contribution margin divided by the sales, which is the base for the contribution margin. We need the ratio in order to calculate the break-even point in dollars. So I'll stop. We stopped for the last lecture in learning objective number 4. So let's continue. And I will start with learning objective number 4. What will be the effect if we change some components for the equation? So the effects on the net operating income of changes in variable expenses, fixed expenses, and selling price or sales volume. So let's discuss if we have any change for the components of the equation, what will be the effect for the net income? Additional applications for the CVP concepts. Example number 1, change in fixed cost and sales volume. Change in fixed cost and sales volume. So we will assume or change some components for the equation. Example number 1, change in the fixed cost and the sales volume. What is the profit impact? What will be the profit impact if the company RBC can increase the unit sales from 500 to 540, okay, by increasing the monthly advertising budget by 10,000. Now, if I need to increase the units sold or the sales volume from 500 units to 540 units, we need to increase the advertising budget by 10,000. Remember that the 10,000 referring to advertising expenses, this will be a fixed expenses, not variable expenses. Okay, so we need to increase here the fixed expenses and increase the sales volume. Now, we need to prepare an income statement for each level of volume. Assuming that we do have an increase also in the fixed expenses. Now, we do have two columns. The first column representing 500 units, which is the current position for the company. We are selling 500 units, and the proposed option that we will sell 540 units. We will prepare the income statement for the two situations, assuming that, and remember that the price for the company or the unit price will be $500. This is given. And the variable cost per one unit will be $300. This is given and are important for the preparation of the income statement. Now, the sales, which is the first component for the income statement, represented by how many units do I sell, multiplied by the price for one unit. So giving a price of $500, we will say $500 multiplied by 500 units. This equals to $250,000, the sales amount for the first level, which is 500 units. If we increase our sales volume from 500 to 540, the sales will be changed accordingly. So $500, which is a price per one, times 540, and this equals to $270,000. This is the sales volume if we sell 540 units. Okay, for the sales. Now we do have a change for 20,000 units, sorry, $20,000 in the sales amount. Similarly, the total variable cost will be changed. Why? Because it is variable. If we sell, then we will pay the total variable cost. So the word variable means it changes in regards of the change of the level of activity. In this case, it is units from 500 units to 540 units. So the variable expenses, according to the current situation, will be 300, referring to the number or the cost. Variable cost per one unit is 300 times 500. This equals to $150,000. I'm paying now variable cost for the current situation, $150,000. If we sell 540 units, this will be multiplied by 300, which means $162,000. $162,000 calculated by 540 multiplied by 300, which is given in the question, the variable cost per one unit. The next step is to calculate the contribution margin. Contribution margin is simply the difference between the sales and the total variable expenses. So for the first situation, I have $250,000 minus $150,000. This equals to $100,000, a contribution margin for the current situation. For the second situation, or the proposed, if you like, situation, $270,000 minus $162,000. This equals to $108,000. So we have additional 8,000 in the contribution margin if we sell 40 units additional to my current situation. After the contribution margin, we have to deduct the fixed costs. Currently, the company pays $80,000 as a fixed expenses. So 80 for the first situation, 90 for the second situation. Why? Because referring to the question, go back, I need to to increase the advertising monthly budget by 10,000. So this will be a fixed expense in addition to the 80,000 that I already pay. So we have to pay 90,000 in total, which is 80,000 plus the advertising expense for 10,000. The total will be 90,000. The net operating income then, the net operating income is the difference between the contribution margin and the fixed expenses. So for the current situation, 100,000 minus 80,000, this equals to $20,000. And for the second situation, 108,000 minus 90,000, and this equals to 18,000. Now, the decision, and this is the most important part for the topic or the question. We sell 40 units in addition to our current situation. So sales volume increased by 40 units, sales amount increased by $20,000 from $250,000 to $270,000. But the net operating income decreased by the 2,000. The net income decreased by 2,000 from 20,000 to $18,000. So definitely if we asked about the advice, and this is the main topic of the managerial accounting, as a managerial accountant, you have to advise the company for this situation. What is your advice? My advice is to reject this proposal. Why? Because financially, the net operating income will decrease by 2,000. So we will refuse or reject this proposal. Either or even we do have an increase in the sales dollar sign or amounts and increase in the contribution margin, but the effect for the net operating income will be bad, will be negative, means we cannot accept this proposal. The net operating income decreased by 2,000, and then we will reject this proposal. So go back to the question. If the suggestion is increasing the sales volume from 500 to 540, but this will affect the fixed costs to increase by 10,000, I will say the final effect for the net operating income will be negative, then I will refuse this option. Okay. We do have a shortcut. If we don't need to prepare all the income statements, the two income statements in this case, we have a shortcut. The shortcut says or summarizes the difference between the increase in the contribution margin and the increase in the fixed expenses. We do have an increase for the contribution margin represented by what? Represented by the 40 units, additional units to be sold, multiplied by the contribution margin per one, which is 200. This equals to $8,000. But this increase in the contribution margin cannot cover the increase in the fixed costs, which is $10,000, which means the fixed cost exceeds the contribution margin, or the additional, if you like, contribution margin by 2,000 in a negative form. So we do have a decrease in the net operating income for 2,000. Again, just to remind you from where we get the 200. Again, the increase in the contribution margin will be how many units do we sell additional for the current situation multiplied by the contribution margin per one unit. And the contribution margin per one unit is calculated from price minus variable cost per one unit. Price is $500, variable cost is $300. So we have a contribution margin per one unit for $200. We will recognize an additional contribution margin for $8,000. But in the same situation, we have to increase our fixed expenses by 10,000. So we will have a decrease in the net operating income, and this is called a shortcut method or solution using something called incremental analysis. If you remember the word incremental in chapter 1, incremental means what is the additional that you will pay. So we will receive additional 8,000 contribution margin, but we will pay additional 10,000 in the fixed costs. So the costs is bigger than the contribution margin or the incremental contribution margin. So we have a shortage or decrease in the net income. So we will not recommend this option. Okay. Example number 2, just to follow the example, we depend on the original example. The original example includes that we do have 500 units to be sold by $500 the price. The variable costs per 1 unit is $300. And we do have $80,000 as a fixed costs. So 3 important numbers, and we depend, all of these examples depend on the original exercise. We sell 500 units and we do have $80,000 as a fixed cost. The selling price is $500 and the variable cost per 1 unit is $300. Example number 2, suppose that we have a change in the variable costs and the sales volume. What is the profit impact if the company can use higher quality raw materials? And remember that the raw materials are variable. So it depends on the units sold in this case. Thus increasing the variable costs per unit by $10 to generate an increase in the unit sales from 500 to 580. Okay, so we do have an increase $10 in addition to the $300 that we already have, and we are thinking to increase the units sold from 500 to 580. So what will be the effect for the profit? In this case, we will prepare the 2 income statements or using the shortcuts again. If we prepare the 2 income statements, originally we are selling 500 units for a price of $500. The variable cost is $300 and the fixed cost is $80,000. Now, the first column represented in this example refers to the current situation, that I'm selling 500 multiplied by $500. This equals to $250,000. If we increase the units sold to 580, the price does not change. So the 580 multiplied by $500, the price per one, this equals to $290,000. Again, the price per 1 unit does not change. So it will be $500 per 1 unit multiplied by 580 units. This equals to $290,000. The variable expenses for the current situation, variable expenses was 300 multiplied by 500, this equals to 150,000. But for the proposal, we are selling 580, but our raw materials, which refers to variable costs, will increase from 300 to 310. We do have an additional $10 additional to the variable expenses referring to the raw materials. So the 580 multiplied by $310, this equals to $179,800. Okay, this will be the variable expenses for the proposal, which is the second column titled by 580 units. Then the contribution margin will be calculated from sales minus the variable expenses. For the first column, we do have 100,000. For the second column, the 290,000 minus $179,800 will equals to $110,200. The fixed expenses do not have any change, so 80,000 in the two columns, and then the net income will be calculated accordingly. The first column will have 20,000 calculated from 100 minus 80,000. The second column will be 110,200 minus 80,000. This equals to 30,200. 30,200. In this case, if we have an increase in the net income, we will recommend the company to go for this proposal. So sales increase by 40,000, but the net income, operating income, increases by $10,200, which is the difference between 30,200 and 20,000. So the net operating income increases by 10,200, which is a positive number, and then we will recommend the company to go for this option. If you use the short method, we will compare between the additional or the incremental contribution margin and any incremental in the costs. Okay, well, we don't have any additional for the fixed cost, so all the contribution margin will be valid or relevant. Okay. Contribution margin in this case is 500 minus 310, if you like. 500, 310, okay? 310 because the variable costs changed for the second option, 310. So we do have 190, okay? 190 times 80, 190 times 80. This equals to 15,200, 15,200. The third example will be the change in fixed cost, selling price, and the sales volume. What is the profit impact if the company cuts its selling price $20 per unit, which means I will sell not for $500. Now the new price will be $480, $480. If we cut the selling price by $20 per unit, which means I'm selling depending on $480, not $500. And we do have increase in the advertising budget by 15,000 per month. This is referring to a fixed cost. So the fixed cost will increase by 15,000. Originally we have 80,000 dollars. So the new number will be $95,000 and increases the sales volume from 500 to 650 units per month. So the new sales volume will be 650, and we need to calculate the net operating income for the new situation. The sales, similarly, we have a new price for the second column, which is the new column titled by 650 units. So 650 units times 480, this equals to $312,000, $312,000. The variable expenses, go back to the question. We don't have any change for the variable expenses. So the number is calculated from 650 times what? Times 300. 650 times 300. This equals to $195,000. $195,000. So the contribution margin will be what? 117, which is the difference between 312 312,000 minus 195,000. This equals to 117,000. 117,000. Minus the fixed expenses will become 95,000. Why? Go back to the question. We have an advertising increase or advertising expense for $15,000 in addition to the 80 that we already have. So the expenses will be $95,000. Okay. So the net operating income will be $22,000. $22,000. We do have an increase in the net operating income for $2,000. Then we can accept this offer to decrease our price in order to have 150 additional units to be sold. We will recognize net operating income 22,000, which is bigger than our current situation by 2,000. Now we can also calculate it in a shortcut. The shortcut means what is the incremental contribution margin recognized and what is the incremental fixed cost that we have. Incremental contribution margin, we do have 17,000. 17,000. And the incremental fixed costs, we have 15,000 additional fixed cost added to the proposal. Then we have 2,000 positive number change in the net operating income, which means we do have already 20,000 and the current the proposal will increase the net operating income by 2,000, which is the difference between additional contribution margin and the additional fixed cost that we pay. Okay. Contribution margin per one, if you like, per contribution margin per one. 480 the price minus variable cost per one, which is 300. This equals to $180. The contribution margin per one, $180. Multiply by 650. This equals to 117,000. 117,000 compared to 95,000, and we do have an increase in the net income for 2,000. Referring to the first example, the shortcuts, and apply it to the third example, 480 minus 300, which is 180, right? 180 times how many units do we have additional? Okay, so we have 150 additional unit, which is 650 minus the 500. We do have 150 units added to the sales volume. Multiply by 180. This equals to $27,000. $27,000 minus, we will say, the additional fixed costs, which is 15. Okay. Okay. Number 4. What is the change in variable cost, fixed cost, and the sales volume? What is the profit impact if the company pays a $15 sales commission per bike sold instead of paying sellers or salespersons flat salaries that currently total $6,000 per month? Now, I will change the structure of my expenses. Instead of paying a fixed cost for $6,000 referring to the salaries, I will pay $15 per 1 unit sold. The difference between the two proposals, the first one I'm paying fixed costs. The second one will be a variable cost. So I'm changing the structure of some of my expenses. So my fixed expenses will be decreased by 6,000, but the sales commission refers to a variable expense. So we are increasing our variable expenses, but decreasing our fixed cost. And this is unit sales from 500 to 575. So we need to prepare the two income statements in this case. The current situation, as we say, we do have a net operating income of 20,000. For the new proposal, we do have 575 units multiplied by, we don't have any change for the price, so it remains 500. So 575 times 500, this equals to $287,500. The variable expenses will increase from 300 to 315. So 315 per one unit multiplied by 575 units, this equals to $181,125. The new variable cost for the company. And then the contribution margin will be what? The difference between sales and the variable expenses. This equals to $106,375. Okay. The fixed expenses decreased by 6,000 to become $74,000. So we decrease our fixed costs by 6,000. Okay, so it will become 74,000. And then the net operating income will be 32,375. So we do have also an advantage here that our net operating income will increase by 12,375. So our advice for the company to go for this proposal. We can do this proposal, which means paying $15 per one bike sold instead of paying a flat or fixed salaries for 6,000, and we can earn good profit if we sell additional 75 bikes in addition to the 500. This also can be a benefit for the company. Okay. Okay. Now, we have an offer to sell 150 bikes to a wholesaler, but they are negotiating about the price. Now, example number 5, change in the selling price. If the company has an opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers or fixed expenses, what price would, in quotes, or would it quote to the wholesaler if it wants to increase the monthly profit by 3,000? Now, our target is increasing or to decrease my net operating income by 3,000 only. So what will be the minimum price that we can offer for the wholesaler? In this case, I will say that I need 3,000 as an additional to the net operating income. So I need to calculate what is the amount for each bike to contribute in this amount for the net operating income. We need $3,000 as an increase in our net income, divided by 150 bikes. So we need $20 from each bike, its contribution, if you like, to the income or net operating income. Okay, so the $20 will affect directly the net operating income for the company. We need $20 from each bike to be a contribution for the net operating income or additional amount for the net operating income from each bike. And we will add the 300 variable costs per one bike already given for this company, the 300 related to each bike, then at least we can ask for 320 per bike as a selling price required for that special order. So if we have an opportunity to sell 150 bikes for a price of 320 per bike, this will earn for a company $48,000 additional or incremental sales amount. So we can earn or recognize $48,000 in the sales, minus the total variable costs, which is 150 bikes times $300. This equals to $45,000. Then we can earn the $3,000 in the net income. Similarly, if you like, if the company asks for, let's say, $10,000, okay, $10,000 additional to the net income, then we will say that 10,000 is referring to 150 bikes. So each bike will have $67 to be added to the net operating income. Okay, for calculation, if you like, if we need $15,000 divided by 150 bikes, we need each bike to add $100 for the net income, and we will add the $300 as a variable cost. So we need a price of $400. Okay, so we need, if we need the given number for the question is the incremental amount for the profits, we need to recognize additional 3,000 for the profit. So how it distributes by the bikes, we need 3,000 for the total amount that we can add for the bikes, which is 150 bikes. Then we need $20 for each bike to add to the net operating income, plus the variable cost, which is already there. So we need $320 as a minimum price to add our net operating income by 3,000. Okay, and if we change the 3,000 to as we say 15,000, then divided by how many bikes plus the variable expense. And this is an important topic for the contribution margin. The equation and formula methods can be used to determine the unit sales and dollar sales needed to achieve the target profit of zero. Just to remind you that the profit of zero is called break even. So the question for this learning objective, what will be the break even point for the company if we have the formula method or the equation method? The word break even is enough to say that the profit should be zero. Profit should be zero, okay? Now, we will use two formulas or two methods. The first one is called the equation method, and the second one is called the formula method. So, the equation and formula method can be used to determine the unit sales, which means or refers to the break-even point in units, or the break-even point in dollar sales amount needed to achieve a target profit of zero. We will use the same information for the RBC company to complete the break-even analysis. Assume that we have this example. The company is currently selling 500 bicycles for a price of $500. Look at the second column. The per unit price is 500. The variable cost per one unit is 300. And the fixed expenses is 80,000. Remember that the 200 is called contribution margin per one unit. Contribution margin per one unit, which is the price minus variable cost per one unit, which is $200 per one unit. If you say contribution margin in total, then this will be calculated from sales minus total variable expenses for the company, which is 250,000 minus 150,000. This equals to 100,000. This is for the whole units, and the 200 is per one unit. Okay. The equation method relies on the basic profit equation introduced earlier in this chapter and in the previous chapter. Because racing bicycle has only one product, RBC, we'll use the contribution margin form of this equation to perform the break-even calculations. We calculate the break-even by solving the equation below. Now, look at this equation and remember what we introduced in the first chapter and in chapter 5 also. The profits, if we look to the income statement here and start with the profit, we will say profit is equal to what? Sales minus variable cost in total minus total fixed costs, right? Now we can say that the sales represented by units multiplied by price, which is QP, minus total variable cost, which is QV per one unit. Units Q refers to how many units do we sell, multiplied by variable cost per one unit, all minus total fixed costs. The Q will be the common between the sales and the total variable cost. So Q times P minus V, all minus TFC, which is total fixed costs. Now we know that the P minus V is called the contribution margin. Contribution margin. So Q times contribution margin, all minus total fixed cost, is equal to the profit. Okay, the profit for the break even should be zero. So we will say 0 equals 200 will be the contribution margin per one unit times Q minus the fixed cost, which is given in the question for $80,000. So the Q is equal to 80,000 divided by 200, this equals to 400 units. Again, we're trying to calculate how many units do we need to break even. Again, from this learning objective, which is 5, determine the break-even point. The question is, what is the break-even point for the company? For the first and the second slide, we are trying to calculate how many units do we need to break even. The key for this question is to know the word break even means profit should be 0. Okay, now we will start the analysis by the equation method. Equation, which is here in this slide, profit equals contribution margin per 1 unit multiplied by quantity, which refers to how many units do we sell, minus the fixed expenses. From our question, we do have the profit should be 0. Why? Because the word break even. The contribution margin per 1 unit is equal to $200 multiplied by quantity, which is missing in this case. My question again, how many units do we need to break even? So the Q will be missing, minus the fixed expenses. The contribution margin is calculated from the previous slide for 200, which is 500 price minus 300 variable cost per 1 unit. This equals to 200. So we can calculate the Q in this case by the fixed expenses dividing by the contribution margin per 1 unit. So the Q is equal to 80,000 divided by $200, and this equals to 400 units. 400 units, which means the company should sell 400 units in order to recognize a 0 profit, which is refers to the break-even point in units. This is called the equation method, and the other method is called the formula method. The formula method is a shortcut version of the equation method. It centers on the idea discussed earlier in the chapter that each unit sold provides a certain amount of contribution margin that goes toward covering the fixed expenses. So we can calculate the break-even point in units by dividing the fixed costs by the contribution margin per 1 unit. So it is simply 80,000 divided by 200, which is contribution margin per 1 unit. This equals to 400 units. 400 units. Again, we need to sell 400 units in order to break even, which means the profit is 0 for that point. Another important topic for the break even, if you remember the graph, we do have a break even refers to units in the x-axis and then a dollar sign in the y-axis. So we just calculated the x-axis amount for the break even, which refers to the 400 units. Can we calculate it in a dollar sign, which refers to the y-axis? Yes. How to calculate the dollar sign or the dollar sales amount for the break even? Suppose that the company RBC wants to compute the sales dollars required to break even. Again, the break even means earn a target profit of 0. We will use the equation method and the formula method to solve this problem. So the question here, what is the break even point in dollar sales amount? In dollar sales amount, not in units, which refers to the y-axis, not the x-axis. Okay, the profits or the equation method is shown as follows. Profit is equals to contribution margin ratio, not the contribution margin, multiplied by the sales, all minus the fixed costs. Okay. The only difference, we will use the ratio, not the CM as a number, the ratio. Multiply by the sales minus fixed expenses, this equals to the profit. Now, the profit is zero in this case. The contribution margin ratio, if you remember from previous lecture, we calculate the contribution margin as follows. CM ratio is equal to CM divided by the price. CM per one divided by the price. If we are talking about the total, then the total contribution margin divided by the sales, which is the total of the price multiplied by the quantity. The contribution margin per 1 unit is equal to 200 divided by the price, which is 500. This equals to 40% or 0.4. So 0, which is the profit in the break-even situation, equals the contribution margin ratio is 40% or 0.4 times the sales, which is missing for this question. We need the sales amount for the break-even point, all minus the 80,000, which is given in the question. Okay. So 40% sales is equal to $80,000. Then the sales will equal to 80,000 divided by 0.4 or 40%. And then the sales will equal to $200,000, $200,000. And it is simply, if you like, 400 units times the price, which is $500. This equals to $200,000 in the sales total. This is the equation method to calculate the break-even in dollar sales amount. What about the shortcut, or what we called it formula method? The break-even dollar sign using the CM ratio or the formula method. Now, let's use the formula method to calculate the dollar sign or the dollar sales at the break-even point. Simply, we will use the contribution margin ratio instead of the contribution margin. So the break-even point in dollar sales is equal to what? The fixed expenses divided by CM ratio, and this is the only difference. We divide by the CM ratio, not the CM. If you divide by the CM, this will give me the break-even point in units. But using the CM ratio, this will give me the break-even in the dollar sales. So we will say 80,000 fixed expenses divided by CM ratio, which is calculated to be 0.4 or 40%. This equals to $200,000, the break-even in sales dollars. Quiz. Coffee Clutch is an espresso stand in a downtown office building. The average selling price of a cup of coffee is $1.49 price. The average variable expenses per cup is $0.36. The average fixed expenses per month is $1,300. An average of 2,100 cups, number of units, are sold each month. What will be the break-even sales dollars? What is the break-even sales dollars? Okay. The break-even point represented by sales dollars is equal to what? Fixed expenses divided by CM ratio, okay, CM ratio. Now, we need to calculate the same ratio if you like, and remember the first quiz for the last lecture, we calculate the same ratio, but I will repeat it. The CM ratio is equal to CM divided by price, CM divided by price. CM in this case refers to price minus variable expenses. 1.49 minus 0.36, this equals the contribution margin for $1.13, $1.13. This will give you the contribution margin. If we need the contribution margin ratio, this number will be divided by the price, which is 1.49. So 1.13 divided by 1.49, this equals to, rounded, 0.758, rounded, 0.758. Now, go back to the break-even point in sales dollars. The fixed expenses is $1,000 or $1,300 divided by the contribution margin ratio, which is 0.758. So 1,300 divided by 0.758, this equals to $1,715. In this case, I'm calculating the break-even point in sales dollars. So the answer simply will be B, 1,715. Remember that we're using the ratio because we need the break-even in sales dollars, not in units. If we need in units, then we will divide by the CM only. The next quiz check 3, Coffee Clash, the same company, but the requirement is what is the break-even in units, and be careful about the difference between these two examples or quizzes. Break-even point in units, we need only the contribution margin per unit. So it is equal to the fixed costs divided by contribution margin only, not ratio. So the fixed cost is 1,300 divided by what? Divided by contribution margin, calculated to be 1.13. 1.13 comes from what? The price, 1.49, minus variable cost per 1 unit, which is 0.36 or 36. This equals to 1.13. So 1,300 divided by 1.13, this equals to 1,150 cups or units. This is the difference between the two quizzes, which is the main topic of this lecture, the break-even point in units and break-even point in sales dollars. That's all for today. This is important just to finalize the most important topics that we have today. The break-even point in units using the equation method or formula method or the CM method, and the break-even point in sales dollars using also the equation method and the formula or CM method. That's all for today, and I will stop at the beginning of learning objective number 6. Determine the level of sales needed to achieve a desired target profit. Thank you for today.